Welcome, Optuma users, to this multi-part educational series from GoNoGo Charts. My name is Tyler Wood. I'm a CMT charter holder, and I'm joined today, as always, by Alex Cole, the Chief of Charts and creator of these GoNoGo tools. How are you doing today, my friend?
Doing very well, thanks. Excited to get going with this educational material.
Absolutely. So here at GoNoGo Charts, we are firm believers that even an unsophisticated, simple process is better than no process at all. We want to have a repeatable, rules-based checklist to help guide us through the markets, right? We want to avoid any of the emotional pitfalls of fear and greed, a lot of the investor behavioral biases that we are all governed by as human beings. And so to talk about that checklist of tools, Alex, why don't you talk a little bit about what's going on with your teenage son right now?
Yeah, so end of the school year and a lot going on with my daughter graduating from middle school. But like you said, my son is going to be a junior next year and he's learning to drive. And like any parent, I'm sure, we want our children to be as safe as possible when getting behind the wheel of a car. And so if you think about some of the things that you would want them to do every single time before they pull out into the road, you've got to fasten your seatbelt. You want to put your foot on the brake so you don't accidentally jump forward. You want to check your mirrors to see if there's anything to your left and your right. You want to signal to alert people coming behind you that you're going to pull out in front. You're going to engage a gear finally, and you're going to drive off. And if you do those things every single time, you're less likely to pull into oncoming traffic and cause any kind of accidents. And so the same can be said when learning technical analysis, when using our discipline to understand and to make investment decisions in as safe as possible environment while removing any unnecessary risk. And you can do that with any number of different tools. It could be Dow theory, trend lines, moving averages, pattern analysis. It could be support and resistance. You could be using indicators, as we'll see, to go through a sound checklist to put the weight of the evidence in your favor. And so how might we go about doing that? Well, we know that when we do this, what we're doing is arguably the most important thing we can do. We're learning a skill that's going to stand us in good stead going forward, because if we can identify trends in price action, we're going to be able to trade in the direction of that trend, profit on the majority of the move. Now, we like to say that that's simple. It's a simple concept, but it's not easy to execute. But if we can do that, then we're going to stack the odds in our favor.
Now, the first step in any kind of trend identification could be just a simple visual scan of the price action. Can you discern any movement, perhaps from lower left to upper right? It's going to tell you there's a series of higher highs and higher lows, the definition of an uptrend, or a series of lower highs and lower lows in a downtrend. Now, this is very subjective, right? And it's only useful in hindsight. So for most portfolio managers, traders, and analysts, we don't know what exists beyond the right side of the chart. And if we have to wait until the trend is fully confirmed in order to participate, we're going to miss profitable opportunities to enter those trends. So the first step in taking that subjective hindsight process into a more objective framework could be to use a tool like Donchian channels. Now, these are very simply plotting a line above and below price action that's going to represent our current high and low over a look-back period. Now, tracking those new highs and lows over the set period is going to help us objectively isolate and identify trends. For those of you familiar with the turtle traders, Richard Dennis taught a group of totally inexperienced financial participants how to follow trends. And Donchian channels was one of the core inputs to their security entries. We had the great fortune of speaking with and spending some time with Jerry Parker at the CMT symposium earlier this spring, and so many lessons about trend following that really haven't changed drastically from when he first started learning from Richard Dennis. So Donchian channels, a very simple idea and concept for identifying movements in price action that can identify a trend. But now, Alex, let's talk about maybe the most widely used indicator of all, the simple moving average.
How many people have simple moving averages on their charts, Tyler, that say they're not technicians?
All of them.
We see that all the time. They don't even consider themselves students of technical analysis. but they will have a 50 and a 200 period moving average on their chart. And it's for good reason. Looking at where price is in relation to a historical average gives you a lot of information about the way that market is trading. If you think about it, it's inherently bullish when price is above the historical average of its prices. It means that price is trading higher than it has in the past. And that means that there's some conviction. People are pushing price higher. So looking at something like a simple average, something as simple as that, it's even in the name, right? The simple moving average, something just that basic will give us a sense of whether or not price is moving in a bullish direction or a bearish direction.
And there's a little bit of interpretation needed, right? Are you looking at price action above a historical average? Are you looking at price action above that simple moving average that is sloping upward, right? So there's a bit of skill in interpreting the data that's on your chart. Now, where a lot of analysts think, well, one moving average is powerful. What if I add even more, 2, 3, 4, 5 moving averages? That's going to give us additional information, not just about price's relation to the simple moving average, but multiple periodicities for the moving averages and their crosses. So a shorter term, like a 20 period crossing above a 50 period, or 50 period above a 200 period moving average, is going to give us important signals for where we could look to enter or exit trends. So right here, we're plotting a 50 period crossing above a 20 period, a 20 period moving average, crossing above a 50 period moving average, and then crossing back below. Now, the parameters that you use on your simple moving averages are going to dictate how frequently your trading signals are coming. And again, these are just simple moving averages. So there's a lot more information that we could add to this chart. Alex, let's talk about the next one from our good friend, John Bollinger.
Yeah, of course. Bollinger Bands have been a technical indicator used by people in our industry for decades now, but they give us so much valuable information. If you remember back to your math classes, seems like 100 years ago, we know that it is statistically significant when price is moving outside of 2 standard deviations, right? If you think back to what we know from our maths classes, 2 standard deviations should encompass about 95% of a normally distributed data set. So anything outside of those standard deviations will be significant. And we know that financial data is not normally distributed. Of course, it's not exactly 95% of the time that price will fall within those bands. But when price trades to these outer extremes, we know that that is significant because the vast majority of data will trade within the bands. So we also know that there's a couple of different ways to interpret Bollinger Bands. And one of the most important for trend following is that when the bands are relatively narrow and then price trades up to that limit and beyond, then we are told to trade in the direction of the break. So when we have the Bollinger Bands narrowing and price trading up and out of those bands, that is an indication perhaps of a move starting in that direction.
So we've got some trend annotation, right? We can draw some lines to capture a series of higher highs and higher lows. We could look at moving averages. We could look at Donchian channels to signal the start of new trends or the end of those trends. We could look at Bollinger Bands for additional trend indications. But of course, there are other pieces of information that we want to confirm or perhaps deny what we are seeing in price action. So the next piece we could add to our chart would be a volume histogram. And Charles H. Dow, 130 years ago, told us the importance of this confirmatory indicator, that price action is important, but if it's not supported with enthusiasm by market participants, then we know that that trend might be coming to a period of exhaustion. So we're going to look at volume to confirm or diverge from what we're seeing in price trends. Now, we're starting to see that we're adding a few very responsible tools to this chart, but price is beginning to take up smaller real estate on our data visualization as we add additional tools. Alex, let's just take one more and look at a moving average convergence divergence from Gerald.
Yeah, and of course, typically people will add a lot more than this, but let's just take one more indicator that people use to confirm or not confirm what we're seeing in price. It's in the name, moving average convergence divergence, right? But the way this one works is by using 2 lines, we're going to get crosses between the MACD line and its signal line. Now, the MACD line looks at the difference between different moving averages, and the signal line is a smooth version of that line so we can get signals. But what a lot of people also look at is where is the MACD relative to the zero line. If MACD is above the zero line, that's bullish in nature because it's telling us that the shorter term averages are moving higher than the longer term averages. And so anytime we've got MACD or its signal or both above zero, that could be considered bullish as well.
And now somewhere here in the center of this chart, we can start to see the weight of the evidence coming together in favor of identifying the new trend, a new upward trend. Now, this checklist that we're using is very, very simple, right? Only a few components, but it's at least responsible in the sense that we're looking at multiple indicators for confirmation of what we're seeing. Now, the problem here is that there's some subjectivity. We have to interpret the signals that are on our chart. And we know with technical tools, as Alex and I went through the CMT curriculum years ago, the more you learn, the more important that next piece of information is to add to your chart. And instead of seeing this simple process, which is already starting to complicate what we're seeing visually, we might get a chart that looks like this, where the price panel has become so narrow we can't even see price action anymore. We can't identify important areas of support and resistance. And most importantly, those additional derivative indicators, at worst, they could be redundant, but at worst, they could be contradictory. And so when we think about our trade decision making, the signal that we're going to use to enter or exit or hold a position, we have to start to think about how complex our chart can be and still be able to process that objectively. If there are enough squiggly lines on the chart, you can reintroduce all of those behavioral biases, all of the emotions of fear and greed that might make you stick with a trade that's down 20% and working against you because you have conviction in that security that it's going to come back to break even. Now, we want to remove subjectivity, as we said at the beginning, but when we add additional panels and tools to our chart, we begin to reintroduce that analysis paralysis and indicator overload. So Alex, talk to us a little bit about the solution with GoNoGo Trend.
So the idea became to incorporate all of the information that we wanted, that we needed, that we've learned from working with people in the industry is going to give us that sensible, disciplined process to allow us to make good decisions. We want all that information, but we want it in a way that doesn't clutter our chart. And so what we end up with is the GoNoGo Trend, and it blends some of the foundational trend following concepts with some tried and true, robust statistical measures of trend identification into an indicator that color codes the price bar based on the strength of its trend. And you can see here, we've got 5 colors. We've got 2 for go conditions, which are our bullish environment. The weak form is aqua and the strong form is that brighter blue. We've got 2 for our no-go conditions, the bearish condition. We've got pink, the weak form, and purple, the strong form. And there are a couple of amber bars on there, and those bars represent uncertainty or neutrality. It's telling us that not enough criteria being met, either in the go side or the no-go side, to identify a trend. And we call those the go fish bars. So we've got go, no-go, and go fish. Go fish, of course, because we're both big fans of the work and the life and times of Jesse Livermore. And he was famous for saying there's a time to go long, a time to go short, and a time to go fishing, when the market just doesn't give you enough information to make a decision.
Now, of course, as we said, the most important indicator of all is price action itself. So when we can compute all of those indicators in the background, maintain that weight of the evidence, but still give ourselves a clear picture of price action, we can do some of our classical work, identifying important areas of resistance that then become support. That's that concept of polarity. We can identify even price patterns or do other annotations on our chart, looking for Fibonacci extensions or retracements during the trade. That is critically important to us as technical analysts, to not allow our indicators to overload our chart and for us to keep our focus on price. Now, Alex and I are so proud of this work and the lessons that we've learned sitting at the right hand of institutional portfolio managers, analysts, and traders over these last years, that we want to bring that to everyone. And we're so proud that we're giving it away for free. So right in your Optuma platform, you can apply the GoNoGo Trend Indicator and use it for free. All we would ask is that you just let us know what time period you're using, what securities you're trading, and if that has changed your decision-making process. So thanks so much for being with us today. Hopefully this has been a helpful session to you, and that you'll join us again in this multi-part educational series for Optuma. Thanks so much. Until next time, be well, trade safe.